Yeah, so from that you can get the net cash flow from operating activity. And now let's move on to the second question. So this is the formal type of a question that you will get at the exam, because they'll usually give a statement of a financial position and a profit or loss, and to get the relevant adjustments done. Not a simple example like question number 1. So let's read off the question number 2. They have given us with a financial position statement. Yeah, so they have given us with a statement of financial position, and also they have given us with the statement of profit or loss. And there are some notes saying operating expenses included in a profit include a loss, on disposal of non-current assets of $5,000 during the year, and item of plant was disposed of. That plant originally cost $80,000 and had accumulated depreciation to the date of disposal $15,000. So the requirement is to prepare the cash flow statement based on the indirect method. And yeah. So first of all, what you have to do is you have to deal with the adjustments first in a question like this. So operating expenses include a loss on disposal of non-current assets of $5,000. So this is a non-cash outflow, we would say, because this loss is not an actual outflow of cash from the entity. It is just a figure that we state in the statement of profit or loss as a loss. So what we have to do is we have to prepare a T account for this disposal. Under that T account, we have to put the loss, and they have separately given the cost of the plant and accumulated depreciation. So when you have the cost of the plant and accumulated depreciation and the loss, the next amount you can find by balancing the T account is the cash proceeds received by selling this particular non-current asset. So that particular cash amount received would come under the investing activity, because this is a non-current asset, we are selling it, which means an investment. So the amount which received, the amount that we will be receiving by selling this non-current asset will come under the investing activity. And also this will have an impact on the non-current asset cost account, non-current asset accumulated depreciation account as well. So let's first start off with the non-current assets. So prepare a T account for non-current assets. You can put the opening balance and closing balance, and that particular disposed assets cost will have to be removed from this account. So when you remove that, and when you put the opening balance and closing balance, whatever the balancing figure, we can take it as equipments purchased, the non-current assets purchased during the period, which is again coming under an outflow under the investing activity. And the accumulated depreciation, you can put the opening and closing. You can get the annual depreciation figure. You can get the annual depreciation figure. No, I'm sorry. You can put the depreciation, accumulated depreciation for the disposed equipment. When you remove that, the balancing figure will give you the annual depreciation. So this annual depreciation is again coming under the profit before interest and tax adjustment, the cash statement of cash flows, because depreciation is again a non-cash outflow. So we have to adjust it to convert this profit before interest and tax into a cash figure. So whatever the amount which is being deducted as depreciation, we'll be adding it back by balancing the accumulated depreciation account. So current assets, as you all know, as I explained in the presentation, any decrease in the inventory, which has happened in this question as well, it has been decreased from 105 in 2005 to 98 in 2006. So it's a decrease. So a decrease in current asset is an addition in the statement of cash flows. Again, trade receivables has been increased. So increase in current asset, we'll have to deduct from the statement of cash flows. And the dividends receivable. So the dividends receivable, you have the opening figure and the closing figure is given to you all. And also under this statement of profit or loss, they've given the annual income, annual dividend income. Remember, this dividends is not dividends, it's not the amount that you have paid to your investors, your company equity holders as dividends. It is the dividends that you have received by investing in some other company. So it is an income for your entity. So you have to put the dividends receivable, you have to draw a separate T account with the opening and closing figures and put the annual dividend income into that. Then the balancing figure will give you all the dividends received in cash. So this dividend received in cash amount again comes under the investing activity. Okay. And then the cash amount. So we discussed about cash and cash equivalents. So it's coming at the bottom part of the statement of cash flows. And then the share capital. So share capital has been increased, means they have issued some shares. So which is coming under, which is considered as a cash inflow in the financing activity. Share premium has been increased. That means the share issue includes a premium. So this premium is also a cash inflow. So we are including it under financing activity because you are issuing your own entities instruments. So which creates a change in the capital structure or the borrowing structure. So obviously it's coming under the financial activity. And then the revaluation surplus. I made a mistake here. So when revaluation surplus, again, if you think carefully, revaluation surplus is also not a cash inflow or outflow. It is just a figure that we are showing that our entities, non-current assets, value has been increased when compared to the market value. So that's the revaluation. So again, there's no cash inflow or outflow. So this revaluation increasement from 12 in 2005 to 212 in 2006, the 200 of increasement, we're putting it under the T account of non-current assets. So non-current assets, if I'm to explain the T account, you have the opening balance 750, you have the closing balance 1048, then you debit it with 200 of revaluation surplus, then you credit it with the cost of the disposed asset, then the balancing figure will only give you the amount of the purchased assets, which is coming under investing activity. So be mindful with that adjustment because revaluation surplus will play a part in the non-current asset account. And then the retained earnings. So retained earnings also very simple. Just draw the tree account, put the opening balance and put the closing balance, and put the annual profit figure because profit only we are accumulating as retained earnings. So put the annual profit figure, credit the annual profit figure, or if it is a loss, debit it. Balance it off. That will give you the dividends paid to the shareholders within this accounting period. So dividends paid to our shareholders, dividends paid to our investors, which is coming under not investing activity but financing activity. And then the loan has been repaid. It has been repaid. It has been decreased from 300 to 200. So it's a repayment of a borrowing, which is coming under financing activity, cash outflow. And trade payables have been decreased, which means under working capital changes, you have to deduct it. The deduction you have to deduct, and the interest accrual. So this interest accrual and tax payable are two separate adjustments that we are showing under two separate lines in the cash flow statement. So interest accrual, draw a T account, put the opening balance, closing balance, and get the annual interest amount from the profit or loss statement, which is 15, and put it to the T account, and by balancing off, you can get the interest paid in cash. And tax payable also do the same thing. Get the opening closing balance, get the annual figure from the profit and loss, balance it off, you can get the tax paid in cash. Okay. So that's it. And so another important concept that I need to mention here is we are taking profit before interest and tax, which is the operating profit, 113 to the statement of cash flows. So this profit figure does not include $15,000 of interest and 57 of dividends, finance charges, income tax. Those things are not included in the profit figure. So under the profit adjustments that we are making, any accruals and any non-cash items including the operating profit only we are reversing back. But these particular items are coming under the heading of coming under the element of operating profit. That means not yet adjusted for this profit element. So we don't have to bother about reversing these elements. We just have to make the necessary adjustment. So I've given you all the answer here on a clear cut. So yeah. So when you all do the adjustments from beginning to the end, if you do your calculations properly, when you put this cash and cash equivalent at the beginning of the period and cash equivalents at the end of the period, you can directly take it out from the statement of financial position. And this net cash from financing activity, this figure that you're finding, it will tally with this cash and cash equivalent amounts. So at the end, it will get balanced to 42. So, but in the exam, it's highly unlikely that they'll give a question where you can balance it off and be happy about it. But sometimes they might give a question like this where you can check the accuracy of your answer by balancing it off. And question number 3. And yeah, question number 3. So this question also, they have given a statement of profit or loss. And together with that, they have given the statement of financial position as well. So similar to the question that we discussed just a while ago. So in this also, they have given a special note saying that during the year, the company paid $90,000 for a new piece of machinery, purchase of equipment. Dividends paid during the year is directly given as 66,000. Interest paid was also given as $28,000. So requirement is to prepare the cash flow statement based on the indirect method. And here, what you have to do first is go to the statement of profit or loss and extract the profit before interest and tax amount. So under this statement, the profit before interest and tax would be the 420 figure. For which interest payable taxation is not yet adjusted. So take that 420 directly to the statement of cash flows and do the necessary adjustments. So let's first start with a note that will be easy for us. So 90,000 for a new piece of machinery. So this is a purchase of equipment, so we have to put it under investing activity. So it is a cash outflow under investing activity. So be mindful when you're drawing the property, plant and equipment account, the cost account. You can put the opening balance and closing balance, and you can debit it with the new purchase. Debit it with the new purchase, and let's keep it for the moment like that, because we might be getting some other adjustments as well do in the cost account. And dividends paid during the year total to 66,000. So this is a direct cash outflow under the financing activity. And interest paid was 28,000. So under the operating activity, you can directly put interest paid as 28,000. And then let's move on to the statement of financial position. So cost, you can put the opening balance, closing balance, then you can debit it with the new purchase. You can balance it off, and then I hope there are no disposals here. Yeah. So you can balance it off, and then you can identify the balancing figure as another new purchase, which is again coming under investing activity. Oh, maybe there should be revaluation. Yeah, since there are no revaluation as well, we have to take that amount as purchase. By looking at the answer, I can say the cash paid for the new machinery is 90. So I think when you prepare the T account by putting the opening balance as 1,560 and closing balance as 1,596 and debiting it with 90 would give you the answer as yeah, something like that. So you just have to put this amount as 90, new purchase as 90. Okay, and yeah, And when you take the depreciation, you can put the opening balance, closing balance, and if they have given you with the annual depreciation, yeah, they have given us with the annual depreciation amount, so you can directly take it to the adjustments under profit before interest and tax. Here I've added back the depreciation as 180. And next, inventory. Inventory has been increased during the period, which means you have to deduct it under the statement of cash flows. Trade receivables has also been increased, which is again we have to deduct it under the working capital adjustments. And bank they have given. So this bank amount is coming under cash and cash equivalents. So when you're determining the figure which is coming under cash and cash equivalents, please check both the current assets as well as current liabilities, because in current liabilities sometimes you might have bank overdrafts, such kind of cash and cash equivalent liabilities. So you have to deduct those from these bank amounts and cash amounts. Then the net figure only you have to take it to the statement of cash flows. Yeah. So statement of cash flows, and then you take the equity and liability. So under that we can see that share capital has been increased, which means a new share issue. So you can put it under the financing activity. Share premium has also been increased. You can put that increase under the financing activity, share premium. And the retained earnings has also been increased. So you can draw a T account, you can put the opening balance and the closing balance, and you can take the annual profit figure. That any remaining balances you can identify as dividend paid to the shareholders. Yeah, so under the cash flow from financing activity, I've given dividends paid during the year 66 by balancing off that retained earning account. And under non-current loans, we can see that the loan has been decreased from 500 to 200, which means the loan payment which is coming under the financing activity. And trade payables have been increased, so you have to add it under the working capital. And taxation, you can draw a D account and put the opening and closing balances, take the annual figure from the statement of profit or loss, and balance it off, and you can get the cash paid up. So yeah, that's the adjustment there. I've explained everything. Yeah. So this part I missed. So when you draw the non-current asset cost account and the non-current asset accumulated depreciation account, put the opening balance as 1,560, closing balance as 1,596. Then put that purchase of 90,000 on the debit side. Then you will be getting a balance on the credit side, which means a disposal. So take that balance into a new account saying disposal account, and by balancing of the depreciation account, put the opening as 224, closing as 318, annual depreciation as 118 from the profit and loss. Then you'll be getting that disposed asset accumulated depreciation. Put that to the disposal account. By balancing off, you can get the cash received from the disposal. You put it under investing activity. So I've mentioned here cash received from disposal is 12. So that's the part I missed, and yeah, that's all for the question number 3. And next we have question number 4. There also you have given with the statement of profit or loss and statement of financial position. So here there are a few adjustments that you need to focus on. So the proceeds of the sale of non-current asset investment amounted to $30,000, and fixtures and fittings with an original cost of $85,000 and a carrying amount of $45,000 was sold for $32,000 during the year. And a breakdown of property, plant, and equipments are given to you all. And $50,000 one shares were issued during the year at a premium of 20 cents per share. Dividends totaling $80,000 were paid during the year. Cash flow statement as IAS 7 is required to be prepared. So first, let's go with the adjustments. proceeds of sale of non-current asset investment amounted to 30,000. So this is a sale of an investment which is coming under the investing activity. So you can directly put this 30,000 as proceeds from selling the non-current investment. And yeah. So we can clearly see in the statement of financial position in 2003 there's a balance of 25 under investments, but in 2000 so there's a small printing mistake here under the statement of financial position. It says the years as 2002 and 2003. So this 2003 should be 2001. So on the right hand side you're given the figures relating to 2001. On the left hand side you're given the figures relating to 2002. So I was talking about the investments. So in 2001 you have a 25 balance under investments, but when it comes to 2002 that balance is not there, which means a disposal. So you can put this amount to a T account, you can put the cost, and you can put the cash proceeds, and you can identify any profit or loss. So this profit or loss will have to be taken to the adjustments under the profit before interest and tax. Clearly mentioned, deduct profit from NCI non-current investment disposal 5. So this profit has been already added to the profit before interest and tax. So you have to deduct it to get it back to the cash figure. So please change these 2 years. So it will be easy for you to do some, and yeah. Investments, that's it. And fixtures and fittings with the original cost of 85,000, carrying amount 45,000, sold for 32,000. So these 3 figures you can put it into a T account and identify any profit or loss. So that profit or loss will have to be reversed back under these adjustments under the profit before interest and tax. So loss from the NCA disposal 13 are added. So this particular adjustment will lead an impact on the cost account and the accumulated depreciation account. So carefully remove this 85,000 of original cost from the non-current asset cost account and carrying amount of 45. So the cost minus the carrying amount will give you the annual accumulated depreciation. That figure you have to deduct it from the accumulated depreciation T account. And sold for 32,000 during the year. So that proceeds, you'll have to mention it under the investing activity. And yeah, so cost amounts are given, accumulated depreciation are given. So put it into T accounts and make the relevant adjustments. So ordinary shares have been issued. So 5,000 into $1 would be 50,000 issued at a share premium. So by looking at these figures under the statement of financial position, you can recognize that adjustment. So share capital has been increased from 150 to 250,000 of inflow, 150 to 160 increment in share premium account. So 10,000 of inflow, which is both are coming under financing activity. And yeah, dividends totaling 80,000 are paid during the year, which is simply an outflow under the financing activity. So go back to the statement of financial position, and there we have done with the property, plant and equipment adjustments, and intangible assets have been increased to 250. So which means a purchase of intangible asset. And investments have been disposed of, and current assets, you have to do the current asset adjustments under the working capital changes. Receivables also the same, and short-term investment. So a short-term investment have been purchased during the year, so which is a cash flow yeah, so it has to be increased, that has been mentioned as purchase of intangible asset 50,000 which is a cash outflow. And then when you go to the cash in hand, you can put as cash and cash equivalents. Share capital done, share premium account done, and revaluation surplus is also there. The increment will come under the non-current asset cost account, and retained earnings, just put the opening and closing balances, put the annual figure, and since the dividend paid amount is given to you all, I think this account is getting balanced. And loan has been obtained. The loan amount has been increased, which will be an inflow under the financing activity. Loan obtained 120. And then bank overdraft is also there. So when you're calculating the cash and cash equivalent amount for this cash in hand amount mentioned under the current asset, you have to deduct the overdraft from that. Then the net figure only you have to take it to the cash and cash equivalent amount in the statement of cash flows. In the taxation also there, just put the opening balance, closing balance, take the annual figure, and identify the amount paid in cash. So that will lead you to the answer. Yeah, all the adjustments are done. So if we have done the sum properly, it will balance to the year end cash and cash equivalent amount 33.